The other thing is that if you look at the exchange for physical numbers, they are actually very, very high. Particularly in gold. Now, what that tells us is that it's effectively it's an arbitrage between COMEX futures and London forwards. The exchange for physical basically is you go out at COMEX. What you do is you go out of COMEX and you go into a forward in order to take delivery. Now, you don't necessarily take delivery. And it could be the other way. So we have no idea as to exactly what the position is in the exchange for physical. But when you get high numbers, you know there is something going on in those markets. And just to remind you, when we had the run-up late 2020, when gold first ran up to challenge new highs, 2070, something like that, there was a crisis in the exchange for physical. And, deliveries couldn't take place between markets because of COVID and all the rest of it. And I seem to recall that HSBC said that on the exchange for physical, they lost over $200 million just on that. So this is actually a very, very serious business. The point about COMEX is that it was never meant to be a delivery market. I mean, the concept of a future is that at expiry, you have the option, if you like, to either sell your future, in which case the position closes out because for every long there's a short. Okay, so it closes out. Or alternatively, you can take delivery. But because it's a very highly leveraged market, the players in futures almost never take delivery. So why is everyone taking delivery now? Well, not everyone, but I mean, you can see that there are huge, huge quantities standing for delivery. And I think a lot of it is there is such demand for gold, particularly from Asia. We can talk about that a little bit, what's driving that. But there is such heavy demand for gold that they're even going in to try and sort of get the loose holders out of futures. So it's a bid-only market in effect for physical, and the only way you can get physical, go along to a refiner and say, when can you let us have some gold? They say back of the queue. If you go to start dealing in the forward market in London, then you might be able to get some. But the amount of liquidity in the vaulting system, in the LBMA's vaulting system, I guess is extremely low. I mean, it shows that they've got, however many thousand tons, but, in practice, very little of that is really available, if you like, to satisfy market deliveries. And we've got the same situation in COMEX. Again, you've got quantities there which are basically not really available for delivery. I mean, some of them may be registered for delivery, some of them may be eligible for delivery, all that sort of stuff. But, the reality is that the liquidity in these markets, in Western markets, is drying up because of demand from Asia. And it's running into that brick wall. And I think this is why you've got these enormous quantities. I mean, 69 tons of gold is not a trifling amount. I mean, this is very, very serious stuff.
The world of gold and silver is undergoing a profound transformation, yet much of the Western investment community seems oblivious. As central banks and sovereign wealth funds accelerate their accumulation of physical gold, and as industrial demand for silver reaches unprecedented levels, the traditional frameworks of precious metals markets are being upended. These shifts are not just economic, they are deeply geopolitical, reflecting a changing global order. A striking development is the growing strain on liquidity within major Western precious metals exchanges like COMEX and the LBMA. Traditionally, these markets were never intended to handle large-scale physical delivery. Futures contracts were designed as hedging instruments, not mechanisms for outright ownership. Yet the rising volume of contracts standing for delivery suggests that buyers are no longer content with paper promises. They want the real thing. The December COMEX contract alone saw 69 tons of gold standing for delivery, an amount larger than the total reserves of many nations. This is not a one-off anomaly. It's a trend that signals deep stress within the system. The LBMA, too, is facing significant challenges, with reported inventories often overstating the true availability of gold for immediate delivery. These developments underscore a critical point. The Western system of leveraged paper gold trading is colliding with the reality of physical demand, primarily driven by Asia. Asia's role in the gold and silver markets cannot be overstated. For years, countries like China and India have been quietly accumulating physical metal, both at the governmental and individual levels. This is not speculation. It's a strategic shift in wealth storage. The People's Bank of China, for instance, has been systematically increasing its gold reserves while reducing its reliance on US dollar assets. This strategy is mirrored by ordinary Chinese citizens, who are turning to gold as a hedge against currency devaluation, particularly in light of falling domestic interest rates. Even in Russia, the trend is similar. Citizens can now open gold accounts at banks, allowing them to accumulate physical gold without the complexities of handling it directly. These accounts are fully backed, unlike Western-style fractional reserve systems. This cultural and strategic preference for gold in Asia is creating a gravitational pull on the global market, draining liquidity from Western vaults. While gold often steals the spotlight, silver's story is equally compelling. The industrial applications of silver, especially in renewable energy technologies like solar panels, are creating a surge in demand. Yet the supply side tells a troubling story. Stockpiles at the LBMA and COMEX are depleting at alarming rates. Even the Shanghai Metals Exchange, a major player in the global silver market, is reporting significant drawdowns. Unlike in previous decades, silver buyers today are not speculators flipping contracts for profit. They are long-term holders, industrial manufacturers securing their future needs, and private investors betting on silver's undervaluation relative to gold. The gold-to-silver ratio, historically around 16:1 when both were considered monetary metals, currently hovers around 85:1. This disparity highlights silver's potential upside, especially as demand outpaces supply. In contrast to the East, Western investors remain largely disengaged from the gold and silver markets. Precious metals make up less than 0.5% of most investment portfolios, dwarfed by allocations to stocks, bonds, and real estate. This disconnect is partly cultural and partly due to decades of financial engineering that have emphasized paper assets over tangible ones. But history has shown that sentiment can shift rapidly. The 1970s saw a massive reallocation into precious metals as inflation eroded the purchasing power of fiat currencies. Could we be on the cusp of a similar awakening? If so, the current low levels of participation in gold and silver markets suggest enormous upside potential. The interplay between dwindling Western inventories, surging Eastern demand, and growing industrial applications is pushing the precious metals market to a breaking point. Central banks, sovereign funds, and private investors in the East are methodically accumulating gold and silver, while the West clings to an over-leveraged system of paper contracts. As these dynamics unfold, one thing is clear. The world is waking up to the enduring value of precious metals. For those paying attention, this is more than a market story. It's a quiet revolution with profound implications for global finance and individual wealth preservation.
This is more than most countries' gold reserves, since stood for delivery on the December contract, on the expiry of the December contract. And also, it seems in its dying days, you see people going out and buying the December contract so they can take delivery. I mean, this is, honestly, Jesse, this is an extraordinary situation. And I think it does tell us that there are strains in the market. Now, we can't know precisely what those strains are, but this is the sort of thing I would expect to see ahead of a fairly significant move up in gold. But that has to be justified. It has to be justified by the fundamentals. And here we come back to the situation over debt, over the stability of credit in terms of its value. Now, clearly, there are central banks around the world who look at the relationship between gold and currency and basically want to get rid of their currency reserves and replace it with gold. What are they doing? Are they buying gold? No, actually, what they're doing is they're getting out of currency. They're getting out of credit. This is the key point. And this is also very much what the People's Bank of China has been doing, and it's being emulated by Chinese nationals, Chinese citizens, who not only take delivery of gold and bars out of the Shanghai Gold Exchange system, they also run gold accounts at their banks. People's China having reduced interest rates a little bit recently, alternative attraction, which is bank deposits, the Chinese housewife will take out a 3-year deposit in order to maximize the interest return. That's all coming down. So, of course, on a relative basis, it makes gold a lot more attractive. And bear in mind also that any Chinese national trying to hedge out of his currency can only do it in gold, because he can't go and buy dollars, buy euros, buy Canadian dollars, whatever. Can't do that. So, gold is the only thing they can do. And of course, Russians now can go and buy gold. I mean, they can run a gold account at their banks. This is a world which is moving towards gold while we've been moving away from it. I mean, we're asleep, if you like, while this is going on. That, I believe, is what's going on. I mean, basically, we're getting to the point where there is so little gold in the West now. And of course, the next thing is that when people wake up in the West, say, "Oh, we better have some gold," they run out and buy ETFs. What's that going to do to prices? I mean, I think it's a one-way ticket. 1,324 tons have disappeared on standing for delivery. Now, I don't think it's actually necessarily gone out of the vaults yet, but I would suspect that, this is all part and parcel of the shortage of silver around. If you're a manufacturer of photovoltaic cells or whatever, and you have been prescient enough to accumulate a stock of silver, which, you must have, okay. Assuming you've been prescient enough to do that, then when you see the price rise, are you going to try and sell some to push the price down a little bit? Are you hell is like you're going to hang on to your silver, so tight it's not going to go anywhere near the markets? Now, these balances are basically what the Silver Institute tell us are the swing factor, which has stopped silver prices going to the moon by these people supplying the market to make up for the shortfall. There comes a point, Jesse, where this no longer happens. There comes a point where suddenly you find that, say, the supplies are not made available, and not only are the supplies not made available, but you find that those pesky people in the markets go and subscribe for physical ETFs. And we need this like a hole in the head because there isn't any silver. So, and they will be playing games. I mean, this is one reason, I'm not actually all that keen on ETFs because you don't have ownership of it. I mean, it's far better that, if you want silver, have the coins, have the bars in your own possession. If you have it in an ETF, I think someone's going to dip their hands in it one way or the other. And you find that you rather wish you'd actually gone for the real stuff. But the point is that there are huge shortages developed in silver.
The growing delivery demands on COMEX and LBMA highlight a structural weakness in Western gold and silver markets. These exchanges, originally designed for financial speculation rather than physical delivery, are now grappling with the realities of tangible demand. When traders stand for delivery in such large volumes, as seen with the 69 tons of gold in the December COMEX contract, it signals a fundamental shift in market behavior. The days when precious metals trading was dominated by speculative paper contracts are waning. Institutional and private buyers, particularly in Asia, are demanding physical delivery. This strain on the system not only raises questions about liquidity, but also foreshadows significant price movements. One of the most concerning trends is the rapid depletion of gold and silver inventories in Western vaults. The LBMA and COMEX report holding substantial quantities, but much of this metal is unavailable for market liquidity. A significant portion is tied up as collateral or allocated to specific contracts, leaving a dwindling pool of metal for actual delivery. For instance, the LBMA vaulting system reports thousands of tons of gold, but much of it is spoken for. Similarly, COMEX's registered and eligible inventories are often overstated relative to what's truly available for immediate delivery. This disconnect between reported reserves and deliverable metal exacerbates market tensions. While gold garners the most attention, silver's story is equally compelling and arguably more precarious. Industrial demand for silver is surging, driven by its critical role in renewable energy technologies, particularly solar panels. Yet the supply chain for silver is strained. The LBMA's silver reserves are depleting at an alarming rate, with stockpiles showing a steady 45-degree downward trajectory. Manufacturers who depend on silver, such as those producing photovoltaic cells, are now holding on to their inventories rather than selling into the market. This behavior is not just speculative, it's a strategic response to anticipated supply shortages. As industrial demand continues to rise and retail investors begin to realize silver's potential, the market could face a dramatic shortfall. The East's growing appetite for gold and silver is a critical driver of these market dynamics. China and India, the world's largest consumers of gold, have been quietly but methodically accumulating physical metal. This isn't limited to central banks. Private citizens are also playing a significant role. In China, gold accounts have become a popular tool for individual investors. These accounts allow citizens to accumulate gold systematically, bypassing the restrictions on foreign currency investments. The People's Bank of China has also been actively purchasing gold to reduce its reliance on US dollar reserves. This strategy is mirrored in Russia, where citizens can open gold accounts at local banks, further fueling demand. The motivations behind this Eastern accumulation are both cultural and strategic. In regions where gold has historically been seen as a symbol of wealth and stability, it is also becoming a hedge against geopolitical risks and currency devaluation. As Western markets face liquidity issues, this steady demand from the East could act as a significant price driver. One of the most telling trends in the precious metals market is the behavior of central banks. Over the past few years, central banks have emerged as net buyers of gold, reversing decades of divestment. This shift reflects a broader strategy to diversify reserves away from fiat currencies, particularly the US dollar. The weaponization of the dollar through sanctions and trade policies has made countries wary of holding large dollar reserves. Nations like China and Russia are leading the charge, swapping dollar assets for gold to reduce their exposure to potential geopolitical risks. This de-dollarization trend is not merely symbolic. It represents a fundamental change in how global reserves are managed. While central banks are acting strategically, the general public is beginning to grasp the implications of currency devaluation. For years, inflation metrics like the Consumer Price Index, CPI, have understated the true erosion of purchasing power. While official inflation rates hover around 2 to 3%, real-world costs for essentials like food, housing, and healthcare tell a different story. When people start to realize that rising prices are not a function of goods becoming more expensive, but rather of their currency losing value, a psychological shift occurs. This awakening often leads to a rush into tangible assets like gold and silver as people seek to preserve their wealth. The result? A surge in demand that traditional markets may struggle to accommodate. The geopolitical landscape is undergoing a seismic shift. The dominance of the US dollar as the world's reserve currency is being challenged by the rise of a multipolar financial system. The BRICS nations, Brazil, Russia, India, China, and South Africa, are at the forefront of this transformation, seeking to establish alternatives to dollar-denominated trade. Gold plays a crucial role in this new financial order. By increasing their gold reserves, BRICS nations are laying the groundwork for a more stable and less dollar-dependent system. This strategy is not just about economics. It's a geopolitical maneuver aimed at reducing Western influence in global trade. While the East accumulates gold and silver, Western investors have been slow to recognize the changing dynamics. Precious metals remain a small fraction of most investment portfolios, with the majority of capital tied up in overvalued stocks and bonds. However, as the cracks in these markets become more apparent, a reallocation of assets is inevitable. When Western investors finally turn to gold and silver, the impact on prices could be dramatic. The combination of increasing demand and constrained supply sets the stage for significant upward price movements. For individual investors, the choice between physical and paper assets is more critical than ever. While ETFs offer convenience, they come with inherent risks, particularly in a market squeeze. Physical gold and silver, whether in the form of coins, bars, or secure accounts, provide a level of security that paper instruments cannot match. Another avenue for investment is the mining sector. While gold and silver miners have underperformed in recent years, they are poised for a resurgence. As prices rise, mining stocks often offer leveraged exposure to the underlying metals, providing the potential for outsized gains. Additionally, some mining companies offer dividends, making them attractive for income-focused investors. The transition we are witnessing in the gold and silver markets is not just a financial trend. It's a reflection of broader economic and geopolitical shifts. The challenges facing fiat currencies, the reallocation of reserves by central banks, and the increasing demand from Asia all point to a future where precious metals play a central role. For investors, this represents both a challenge and an opportunity. Staying ahead of these trends requires not only an understanding of market dynamics, but also a willingness to act decisively. Whether through physical ownership, mining stocks, or strategic diversification, the time to prepare is now. As we navigate this period of economic uncertainty and geopolitical tension, gold and silver stand out as beacons of stability. Their enduring value, proven over millennia, offers a sense of security in an increasingly volatile world. For viewers and investors, the message is clear. Recognize the signs, understand the shifts, and position yourself strategically. The road ahead may be uncertain, but those who embrace the opportunities presented by precious metals will be well equipped to weather the storms and thrive in the years to come. So as we watch these historic changes unfold, let's remember, this isn't just about wealth. It's about resilience, security, and a vision for the future that is as timeless as gold itself.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.